It seems everywhere you turn, someone is predicting a stock market crash. Ever since the V-shaped recovery in 2020, the market has appeared to be on solid ground. At the same time, pundits across the internet are screaming that the sky will soon be falling. This isn't anything new. I've been investing since 2004 and have heard my fair share of doom and gloom. But stocks kept on rising over the years, climbing a wall of worry until some event came along and caused prices to plummet. Now the market is at historically high levels and nervousness is abound. If you have any amount of money in the market, you're probably wondering what I've been wondering. Are we currently in a stock market bubble that is ready to pop at any moment? And if so, what can you do to prepare yourself for what most experts consider inevitable? First, I want to stress that I am not a financial advisor, and everything in this video is for entertainment purposes only. I'm just some guy on the internet after all, and what you'll hear is just my opinion. Before making any financial decisions, do your own due diligence or consult your financial advisor. Also, I've gone to great lengths to make this video evergreen, meaning it should have as much value in the future as it does right now in 2023. Even if a crash has occurred by the time you watch this video, you should have the knowledge to spot the next bubble and prepare for the crash that follows. To paraphrase Warren Buffett, there are two rules for investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. But there's a little more to it than that. Sure, everyone knows to buy low and sell high, but first we must define low and high. Most people assume this means low prices and high prices, but price is only one part of the equation. You could use price to earnings ratios, but there are a lot of assumptions there. Namely, are the company's earnings even accurate? For anyone who claims that company earnings are always accurate because of independent auditors, Enron is a great example of what can go wrong. So, what should you use to determine the value of a company's stock? Dividends don't lie. In Kelly Wright's Dividends Still Don't Lie, the follow-up to the 1988 best-selling classic Dividends Don't Lie by Geraldine Weiss, Wright argues that stocks should be valued, in part, based off of their dividend yield. This theory is aptly named dividend yield theory. So, what is a dividend and a dividend yield? A dividend is a sum of money paid regularly by a company to its shareholders out of its profits or reserves. And a dividend yield is the dividend expressed as a percentage of the current share price. So, for example, if a company pays a dividend that adds up to $5 per year and their share price is $100, then they have a dividend yield of 5%, 5 divided by 100. Dividend yield theory, or DYT, is the basis of the research done by Wright's newsletter IQ Trends, which was founded by Weiss in 1966. The idea is that dividends cannot be faked or altered like earnings can be. Either the money is paid out to shareholders or it isn't. And since dividends don't lie, then an investor can use the historical dividend yield for an individual stock or the entire stock market to determine if it's undervalued or overvalued. This is a simplistic explanation of DYT, so I highly suggest you read both books and consider subscribing to the IQ Trends newsletter. I don't get paid for this endorsement, though I have been a subscriber for 5 years and have found it to be a great resource. Now, there is a way to use DYT when analyzing the market as a whole. We can use historical dividend yield data on the Dow Jones Industrial Average to determine its high and low range. Dividend yield and asset price have an inverse relationship. In other words, when prices go down, dividend yields go up, and vice versa. When prices of stocks go down and their dividend yield goes up, at some point the yields get too high. Then, the underlying assets become attractive enough to bargain hunters and those who can recognize good value when it's on sale. Here's an example. ExxonMobil stock tanked in 2020, and its dividend yield reached a historically high range. This is despite the company's increasing dividend payments over time, as shown in the middle chart. The stock was obviously undervalued, but it took a few months for that value to be recognized by the market. When a large number of high-quality stocks are undervalued and their yields are historically high, this coincides with market bottoms, which is a great time to buy stocks. Conversely, low yield occurs when prices are high, which coincides with market tops. Based off of historical data, this is where a lot of people think we're at now. But how can they be so sure? Here's how it works. By looking at the historical yield of the Dow Jones average, we can see when the yield was historically low during market tops and historically high during market bottoms. So, where are we now? Well, if you're watching this in mid-2023, I have some bad news for you. The yield on the Dow sits at around 2%, which puts valuations roughly where they were during the peaks of 1929 and 2000. This suggests that the market is currently overvalued more than it has been since those two pivotal years. In order to return back to an undervalued range, the yield on the Dow would need to reach 4%, meaning the price would be cut in half. So, valuations are high when considering historical dividend yields using DYT, but are we currently in a bubble? In the book Boom and Bust, A Global History of Financial Bubbles by William Quinn and John D. Turner, the authors describe 3 necessary conditions for a bubble. Think of a financial bubble as a fire. There are 3 things that must be present for the formation of fire: oxygen, fuel, and heat. In the same way, financial bubbles have 3 things that must be present in order for them to occur in the first place. The author refers to the following 3 conditions as the bubble triangle. Number 1, marketability, the oxygen for the boom. If a stock can be freely bought and sold, then it's marketable. The easier it is to buy or sell, the more marketable it is. Also, how divisible the asset is increases its marketability. For example, public companies are more marketable than houses, since you can buy a single share of a business rather than having to buy the whole business. Historically, a house couldn't be divided up into pieces and sold, though during the subprime bubble, financial innovation made it possible. They took a previously indivisible asset, in this case mortgage loans, and made them divisible with the advent of mortgage-backed securities. This was the oxygen for the boom that was the housing bubble. Number 2, money and credit, the fuel. Basically, people need to have money to invest in order for a bubble to form. If they run out of money, they can always borrow more and increase their credit limits. Bubbles are much more likely to occur when there is an abundance of money and credit in the economy. Low interest rates and loose credit leads to people borrowing heavily to purchase the bubble assets, driving up prices even more. To be clear, banks are lending other people's money, and borrowers are borrowing other people's money, and neither are fully on the hook for losses if an investment in a bubble asset fails. When interest rates are low, which is what makes borrowing cheaper, investors are pushed to reach for yield. This means they invest in riskier assets than they usually do, since traditionally safe assets, such as government debt and bank deposits, offer low yields when interest rates are low. Number 3, speculation. The heat. Speculation is the purchase of an asset with the expectation to sell the asset at a later date in order to generate a capital gain. Speculation is always present in the market, but during bubbles, large numbers of novices become speculators. Early speculators make large profits, which drives others to join the party. This further increases the price of the bubble assets. So, what is the spark that sets the bubble fire ablaze? Technological innovation or government policy. As stated earlier, during the subprime bubble that popped in 2008, it was an innovation that acted as the spark. A previously indivisible asset, mortgage loans, was made divisible, and that was all that was needed to start the bubble. Here's how it went. We had the advent of mortgage-backed securities, the innovation. This happened in a market that already had marketable securities. On top of that, it was at a time when interest rates were low, which provided cheap cash investors could borrow to buy assets. As asset prices rose, there was increased speculation. This was because the early speculators were getting rich. All of this led to the bubble that ended in disaster in 2008. So, are these elements present today? I'd argue that, recently, the rise of blockchain technology and artificial intelligence are 2 technological innovations that have helped to spark bubbles. As for government policy, the ultra-low interest rates have helped to raise asset prices to historically high levels. I mean, when you're getting close to 0% on your money when it sits in a bank account, you'll tend to invest it into riskier assets. This is a repeat of what happened prior to 2008. I must note that since the lows of 2020, the Fed has returned to raising interest rates in order to battle inflation, but some argue they aren't raising rates enough, though that is outside the scope of this video. But since all conditions have been met for a bubble, and dividend yield theory points to the market being overvalued more than at any other point in the past 100 years except for 1929 and 2000, I'd suspect that we are on the precipice of a crash. Will the next crash cause an economic downturn? It's important to note that sometimes bubbles don't actually cause recessions or depressions. Sometimes the bubble is confined to a single industry, like the UK bicycle mania or the dot-com bubble. But other times, the shockwaves from the bubble bursting are so huge, a post-bubble financial crisis ensues, such as the Roaring '20s, which led to the Great Depression, and the subprime bubble, which led to the Great Recession. The current economic environment has been described as the everything bubble. Some of these bubbles within the everything bubble have popped. Many of the companies that flourished in 2020 have fallen drastically. These are the so-called stay-at-home stocks and pharmaceuticals. And blockchain-related stocks have fallen along with cryptocurrencies, but they have since made a comeback. And then there's the cannabis bubble that has not yet recovered. But the recent buzz of AI makes me wonder if we're on the verge of a new bubble emerging. Whether or not we're in an everything bubble, it's important to note that the overall market is overvalued historically. In my opinion, a decline in prices is inevitable, even if there are no large-scale economic ramifications as seen during the Great Depression and Great Recession. I'd be surprised if there was no economic fallout if there were a crash, since investors who will get burned the most will be anyone who invests passively, either via ETFs or mutual funds that are invested in the whole stock market. When the whole stock market tanks, a lot of these folks will feel the pain, and they will in turn pull back on purchases, leading to job losses, which will lead to further reduction in spending. That downward spiral could continue for quite some time. Then there's inflation, but it's hard to tell what the Fed will do in the coming years. They could inadvertently tip the economy into recession, but there's always the possibility they pull off a soft landing. When will the crash occur? Anyone who gives you an answer to this is either lying or trying to sell you something. I can say that I have no clue when the stock market will decline substantially. I don't have a crystal ball, but I've heard repeatedly over the years that the market can remain irrational longer than you can remain solvent. In other words, don't bet against the markets when the participants are behaving irrationally, i.e., buying overvalued assets. Instead, now might be a great time to learn about investing and how to identify high-quality stocks that are selling at undervalued prices, even in today's market. Books and newsletters like the ones I'd mentioned earlier are a great place to start. And what if you're fully invested? Well, don't make any rash decisions, especially when selling. Anytime I've made any rash decision, I've always regretted it. If you want to know what I'm doing personally, here it goes. I'm still partially invested and continue to opportunistically buy shares of undervalued companies. Recently, shares of regional banks have gone on sale with the collapse of Silicon Valley Bank. Though I must disclose, I have 70% of the funds I've earmarked for investing in cash. Once the Dow reaches a yield of 4% or higher, I'll start shifting more of that cash into purchasing deeply undervalued, high-quality assets that have a long history of paying a safe and steady dividend. This is my personal strategy and should in no way be considered investment advice. I cannot stress this enough. Learning about investing is a lifelong pursuit, and if you are new to investing, you must put in the effort to study strategies and do some paper trading before putting actual cash to work. Timeless advice. Dividend yield theory has been used successfully since 1966 and will be a valuable strategy in the future. You may be watching this in 2024, 25, or beyond, and if so, you may have hindsight on your side as to if or when the crash actually occurred. Still, DYT and the ability to spot bubbles will be valuable to you since you'll be able to know when the market is overvalued. Instead of being among the speculators that are putting their money into increasingly overvalued assets, you can be choosy and only buy high-quality, undervalued stocks with a long history of dividend payments, since dividends don't lie. And once the market returns to undervalued levels, you'll have even more stocks to choose from. and then the entire cycle will start all over again. I hope you enjoyed this video. I attempted to keep this as simple as possible, though I apologize if I overcomplicated any points. If there's anything about this subject that you'd like me to expand upon in a future video, please leave a comment below. Also, if you'd like me to make a video covering another topic, please be sure to add that as well. Thank you for watching.